Good afternoon, all of you, once again. Today, we'll talk about the balance sheet. What is balance sheet? It is the statement of financial position. Okay, what position does it disclose? It displays the position of assets and liabilities of a business organization as on a given date of time or on a particular point of time. Now, this is the last step of your accounting process. Accounting process is a cycle. It starts with journalizing and ends with balance sheet preparation. What is accounting? It is a process of recording. Where do you record? You record in the journal. And the definition goes on explaining and finally ends with summarizing. Where do you summarize? The summarization process started with your trial balance. The next step of summarization is trading and profit and loss account. Finally, balance sheet preparation. Okay, right. So, liabilities. I told you that it is a statement of liabilities and assets. Now, the liabilities in a horizontal form of balance sheet, we take liabilities on the left side and assets on the right side. Sir, is it must that it liability should be left and assets should be right? Now, sometime back, I was teaching some other country students, and in for them, I had to teach the reverse. Okay, the assets I had to take on the left side and the liabilities on the right side. There is no rule that liability should be left and assets should be right. Okay, it depends on the culture and the country and their accounting policies and standards. Okay, so what we had to understand is now look at this, boys and girls. You don't try to experiment with Usmania University. Like you take liabilities on the right side because Dr. Ravi said you can take anywhere. So therefore he said that you can take anywhere. Therefore I will take liabilities on the right. What's wrong in that? And assets on the left. If this particular point where if this particular point which I told you that it varies from country to country is not known to the examiner, the one who is valuing your script, he will simply give you zero because he doesn't know. You wrote something, you have presented a format, something which is foreign for him, unknown to him. So he'll simply put zero. So therefore, let's not take risk. Whatever is the practice in India and at Usmania University, that only we will do. We'll take liabilities on the left side and assets on the right side. Sir, why do you then, if that is the case, why should you tell me, why should you tell us that liabilities and assets can be taken on any side? Okay, it's your choice. Why do you tell that? Why? Because when you're taking up your higher level education, master's program, maybe master's in accounting or master's in business administration, when you take the higher levels, when you come across such scenario which I told you just now, then you will question me, you will point me out. Oh, Dr. Ravi did not say if this is like this. He told only it should be like this, liability should be left and asset should be right. This is what he told me. So for that purpose, I'm just telling you, preparing you for the next level of learning. Okay. So, but for now, we take liabilities on the left and assets on the right. Now there is a horizontal form. This is horizontal form. Now there is vertical form. Vertical form in the sense you take liabilities at the top and assets at the bottom, or assets at the top and liabilities at the bottom. Okay, just one by one you'll take next row, next row, next row, you will go on taking, right? This is a vertical format. If it is horizontal, there are two sides just like in account, but we don't call it account. We call left side and right side. Left side you can take liabilities list and right side you can take assets list. Okay, right. What are there in liabilities? Let's look into one by one. Number one is capital A, capital. What is this? This is the amount contributed by the owners to the business. Okay, and this could be at the time of starting the business or during the during the process of business, maybe after 2 years or 3 years, if they're going for the expansion requirements, they may infuse some more funds, or they may go for diversification, they may infuse some more capital. So it can be at the starting point, or it can be in the middle. At any point of time they can infuse the capital. Okay, so now we should understand, as per the business entity concept, the owners are different from their organization. They will supply the capital as if the money is given to an outsider. And the business also considers the suppliers of the capital, the owners, as outsiders. Okay, different from their business. Okay, from the business organization. So therefore, for the company, the capital is a liability, because the owner and the organization he owns are different, I told you already. Okay, now when we talk about principles, accounting principles, we'll discuss even more detail. Okay, I'll come back to this concept once again. Okay, now, so capital is one of the items of liabilities. Then reserves and surplus, B, reserves and surplus. And as the business is started, and it starts making profits, okay, it accumulates profits, right? What is that? Excess of incomes over the expenses. So it will keep on increase. What is that you do? You take that profit, okay, and part of that profit, you will distribute to the owners. Maybe if it is 3, 4, or 10, if it is a joint stock company, it is more than 10. Okay, it's more than 7, right? So yeah, there are private limited company, public limited company, which you will learn in business organization and management. That's a different concept. But what we are trying to understand here is, if there are multiple owners, part of the profit, let's say 10 lakhs profit you made, 5 lakhs will be distributed among the owners, and the remaining 5 lakhs will be added back to the capital, right? So that's called reserve. That's called reserve. Okay, that's called reserve. It will be given various names, whatever be the name given, but that is the excess profit after distributing to the owners, you will add back to the capital of the owner, okay, or owners. Now look at this. Mukesh Ambani's Reliance Group capital is more than 200,000 crores. It is more than 200,000 crores, right? They just started with 60,000 capital. Today that capital became 200,000 crores. How it became? On 60,000 they made a profit of 20,000. Okay, out of 20,000 they might have taken only 5,000. Remaining 15,000 they have invested it back, so that the capital became 75,000. On 75,000 they made a profit of again 30,000. They used only 10,000, invested back another 20,000, then it became 95,000. So look at this. When we are starting a business, this is what we do. Part or a minor fragment of that profit, we will use it for ourselves, and the remaining we will add back to the capital, to the very business which gave us this profit. That is reserve. Okay, so it is added to the capital. It is added to the capital, right? Next, C is long-term or non-current liabilities. These are the obligations outside the other organization other than the owner. For example, if the owner is supplying, you're calling it capital, but okay, and that money is used in the business. But if the same money is supplied by a banker, that's called loan. Okay, if the same money is raised from, okay, debt market, that's called a liability. Okay, so these are the obligations which are to be settled over a period of time. Okay, which period? Long period, right? So therefore it is long term liability or non current liability. What is long term or non current liability? If your obligation is beyond 12 months, that's called long term liability. If the obligation is less than 12 months, that's called short term liability, okay, or current liability. Let's look at that. Okay, let's look at that. Yeah, look at this. Yeah, if it is less than 12 months, like what? Like what? You bought material, you had to make payment, and that fellow who has supplied material has given you, let's say, 3 months time to pay. That's an obligation you have to meet, right? So that's less than 12 months, right? Therefore, it is a current obligation or a current liability or a short-term liability. Okay. Or let's say you're postponing the payment of salaries to your employees. How long you can postpone? 3 months you can postpone. Sir, Corona is there. 3 months I'm postponing all the employees. Please bear with us. We are not able to disburse the salaries for 3 months. It can become 4 months, it can become 6 months, not beyond 6 months. Okay, so not beyond 12 months. Even if it is beyond 6 months, it cannot be beyond 12 months. Whatever it is, any obligation that you have to meet within 1 year is current obligation, be it an outstanding expense or be it the creditors who supply the material to you on credit. All these obligations are called as, okay, short-term liabilities. Okay, and not only that, sometimes you may borrow from bank. That's called advance. You may borrow from banks. Okay, in the form of overdraft. What is that? That is a short-term obligation. Let's say if the overdraft is more than 12 months, let's say 5 years overdraft, that's a long-term liability. Okay, but if it is less than 12 months, maybe for 9 months or 10 months, it is a short-term obligation or short-term liability or a current liability. Now, bills payable. Bills payable is a bill payable is just like your creditor. If there is no documental evidence, right, for the creditor, that's simply creditor. If there's a document written called a bill of exchange, which we have seen already, okay, then it is a bill payable. It becomes bill payable. Outstanding expenses you have seen. Now, advances from the customers. This is another point, current liability. What is that? When you had to sell goods, you will, first call for the deposits. They deposit with you, which is repayable. Okay, repayable. So that is the money that belongs to others, but it is for a short-term duration. That's a short-term obligation, right? So now, what are the short-term obligation? Bank overdraft for a short duration, bills payable, outstanding expenses, advances from customers, sundry creditors. These are all the list of the current liabilities. Current liabilities. Let's come to, okay, now let's come to the total list of liabilities. Liabilities consists of capital, okay, reserves and surplus, which is added to the capital, long-term liabilities or non-current liabilities, short-term liabilities or current liabilities. What are the short-term liabilities? Sundry creditors, advances from customers, outstanding expenses, bills payables, bank overdraft. That's it. Let's come to assets. Assets. Okay. Now, what are these assets? These are the resources in the organization to generate revenue in the long run. Okay, and these as long run or short run. Okay, some of the assets may be short run. Okay, let's look at materials. Okay, stock, inventory. That's a short term asset, but that generates some income. Now these are the, these are the items which generate income in the organization. So in accounting language, all debit balances in personal and real accounts are called as assets. Assets are broadly divided into two: fixed assets and current assets. Let's look at the fixed assets. If you're procuring a resource, okay, tangible resource, whose benefit you will reap for years to come, that's a fixed asset. Let's say you're procuring land to erect a plant, that's for a long term, whose benefit you will derive for so many years, 30, 40, 50, 100 years. That's a fixed asset. And you may erect plant on that, and you may construct building on that land. That's a fixed asset. Or you may set up machinery in the factory. Okay, factory which is built on the land, that's for a long term. These are all fixed assets. Okay, fixed investment. These represent the facilities or the resources owned by the business for a longer period. The basic purpose of these resources is not to buy or sell them, but to use them for future revenue generation. The benefit from use of these assets is spread over for a long period. The fixed assets could be in tangible form, okay, like your building, machinery, vehicles, computers, okay, and sometimes this can be in intangible. The patent that you buy, the trademark that you buy, okay, the goodwill, they may be intangible assets. Okay, in the balance sheet, fixed assets are always shown at original cost. Okay, minus depreciation, right? Minus depreciation, and the word used for depreciate, a word used for what is this? Trademarks and patents and goodwill is amortization. Amortization, right? Let's come to investments. These are funds invested outside the business on a temporary basis. Okay, right. At times when the business has surplus funds, they are not immediately required for business purpose. What they do is they just keep that surplus money in the shares of other companies. Okay, maybe in the mutual funds. Okay, so these are investments of class, you can categorize them as fixed asset if it is for long term. If it is for 6 months, then you can treat it as a current asset or current investment. Let us come to current assets. Okay, what are the current assets? Okay, uh, if the assets are satisfying the below rules, then it's a current asset. Like, it is expected to be realized in less than 1 year, or that is in the normal operating cycle. If it is realized, what is that? If it is converted into cash, then that is called current asset. It is held primarily for the purpose of trade. You buy that and sell. If you're procuring that asset for the purpose of selling again in the same form without changing its form, that's a current asset. Or sometimes, yeah, you can change the form, but the purpose is to sell it again. You buy the raw material, you buy the steel plate, and you make a electric tower or a telephone tower and sell it again to the Department of Telecom, right? So what is that? That is, material is transformed, right? Whatever it is, the purpose of procuring that material is to sell it again. That's for trading, being traded. It is due to be realized in 12 months. I told you it is cash or cash equivalent. Okay, sometimes cash also is a liquid asset or current asset. Cash equivalent. What is cash equivalent? It may be treasury bills, or it may be gold. Okay, it may be diamonds or silver. All these are called as cash equivalents, right? So let's look at the list of current assets. The materials, that's called stock or inventory, is one of the current assets. Debtors, the customers to whom you sold the goods on credit, is debtors. This is one of the items. The second item, okay, this order can be according to your convenience, need not be in the same order which I'm presenting. Debtors are the customers to whom you're selling goods on credit. This is one of the types of current assets. If those debtors are, provided with the documentary evidences, that becomes bill of exchange or bill receivable. Okay, then the cash that you have also is current asset. The cash that you have in the bank also is current asset. And some of the expenses that you may meet in advance, right? That's your asset. You pay insurance in advance. That's your asset. What is that? Prepaid expense. You pay the rent in advance. What is that? That's a prepaid rent. And advances to suppliers. What is this? It is, yeah, it is, it is it is your money with others, which is an asset. It is just like prepaid. If your money is with others, it is an asset. Okay, right. Let's come now to the template of the balance sheet. Okay, in Indian scenario, this is the template. Okay, balance sheet of balance sheet of Muhammad Sohail. Okay, as on 31st December 2020. Okay, this is how you have to write the balance sheet. Okay, heading. Now, without heading, if you are writing all the data in this template and your totals also are equal, the individual or the examiner has right to do or give any marks, any score that he feels to give you. If he gives you just, if it if it deserves 12 marks, if he gives you just 2 marks, you can question him, right? He has right to give you 0 also. But very often they reduce 1 or 2 marks. But if there's a crazy guy, he may reduce, okay, 10 marks and just award you 2 marks. So therefore heading is very important. Balance sheet of, okay, balance sheet of, let's say, Vishal Jain, or balance sheet of Pranay, a balance sheet of Ramu at 14, a balance sheet of Uday Kiran, balance sheet of, okay, Tirmalesh, balance sheet of Rohit, Gautam, Durgesh, okay, Praneet Reddy, balance sheet of Naman and Rajat, okay, balance sheet of Shivcharan and Nandasai, balance sheet of Keith Kiran and Kapish Mittal, okay. So you can, it can be any name, but you have to write as on 31st March, okay, 2021, or 31st December 2020, or any date that is given. This is the heading, right? Then you take the list of items under capital and liabilities on the left side, and take the list of items that I have discussed on the right side. Okay, left side, what did we discuss? It started with capital. Okay, capital, right? Then take capital here in the inner column. If there's any profit to be added, add that profit, okay, or reserve. Then it becomes the total capital. Then long-term liabilities, like, okay, loans from banks and other financial institutions. Then you have creditors, bills payable, okay, advances from customers, then any outstanding expenses that you have, right? That is the list of capital and liabilities. Let's look at the assets. The assets list: land minus depreciation. It cannot be, there's no depreciation for land. Okay, yeah, please ignore this one, depreciation. Land, okay. Building less depreciation can be, okay. Building less depreciation, building gets depreciated. I don't see land getting depreciated, okay. There's only appreciation for land, okay, due to increased demand, continuous rise in the demand for the land, causing the land prices to appreciate than depreciating. Okay. Plant and machinery is the next item, less depreciation. Vehicles, minus depreciation or less depreciation. Computer systems, less depreciation. Office equipment, less depreciation. Current assets. What are the current assets? Stock you have. Stock means what? Inventory. Inventory means what? Materials. Materials is of how many types? 3 types. Raw materials, work in progress, and finished stock. It can be in any form. If it is the closing stock, drop it here. Remember, only closing stock is taken in the balance sheet. Again, I'm reiterating, only closing stock is taken in the balance sheet. Sir, you will ask me, why do you take the opening stock? Opening stock is taken in the profit and loss account, trading and profit and loss account. Okay, trading and profit and loss account. Then sundry debtors, less provisions. Yeah, we have seen in the income statement in the previous class. Okay, debtors amount you take, and if you are making any provision for doubtful debts, and deduct that provision for doubtful debt, take the net amount on the amount column in the outer column, right? Then bills receivable, cash in hand, cash at bank, prepaid expenses, advances to suppliers. These are all your assets. So the total of the liabilities should be equal with the total of assets, right? Now, I started my sessions in the beginning that balance sheet should always tally. Balance sheet should always tally. Why should it? Why should it tally? Why should it be equal on both the sides? What is that? The total of liabilities here should be equal with the total of assets. Why should it be? Why that condition? Any answers? Answers, please. No answers. Okay. The answer is that you cannot spend more than what you have. What you have is your own money, that is capital, and you borrowed from outside, from banks, from financial institutions, from friends, and you have availed some credit from your suppliers. Okay, your suppliers. Okay, right? So these are all your what you have. These are all what you have, right? And what you are spending is this. You spend on land acquisition, you spend on building, you spend on plant and machinery, you spend on computers, you spend on office equipment, you spend on stocks, you spend on debtors, you spend on, okay, and so many other things. Sir, there can be cash left over, na? Yes, that is what cash left over. So there may be some amount more left over. Yeah, more than that, what I have, I'll deposit in the bank. That's cash at bank. I have this money. I have spent on all these types of assets. The leftover money, I'm just keeping in my hand. Some money is excess to keep in my hand. It is too much to keep it in hand in the chest, in the cashier, with the cashier. It is unsafe for me, I thought. Then I'm depositing in the bank. That's cash at bank, right? So these prepaid expenses and advances to suppliers, this is the money that you're keeping with the with the with outsiders, like the suppliers. You're depositing money so that they supply the material, or these are the prepaid expenses. Okay, rent you paid in advance. Okay, that's your money with others. This is an asset, right? So this is also a kind of spending. After all spending, you're left with cash in hand and cash at bank, right? This is balance sheet. We will take a problem and try to fit in this template so that you will get the confidence, right? So I just want you to raise some questions. Okay, I want you to raise some questions. No questions? Raise some questions so that I can answer you.